The problem is that if you've only been investing for 5 years or less, this is the first real time that you're seeing a market lull or even any substantial dips that could be causing real frustration. You're probably seeing prices of stocks and ETFs that are much lower than what you bought in at, or at least at the same price, which can be very frustrating. I've invested through 3 real market cycles, and I've got 5 rules to help you overcome frustration when starting investing. My name's Nolan Gouveia. My students call me Professor G, and I made this channel to make investing simplified. I also made this channel for this specific topic today, as I see so many people give up when they're so close to hitting that financial freedom. The issue you need to understand is that the frustration is coming from many places and not just the investment itself. Understanding all these will greatly ease your tension and keep you going strong, because your biggest asset is time in the market, so anything we can do to keep you from quitting is going to pay huge dividends. See what I did there? Okay, so rule number 1 is to understand 100% anything that you're going to be putting your money into in the form of an investment. This step gets overlooked by so many people, and if you were to just do this one step, this would help you out so much and ease your tension in so many ways. Do your research. Research is not just watching my YouTube channel and listening to what I like and what I'm investing in. Use my research to start your research. Know that if I'm talking about an ETF or a stock or something, that it's something that I've researched heavily and something that I actually like and that I'm doing, and then it works for my portfolio, but that doesn't mean necessarily that it's going to work for yours. Or maybe it does. You'll only know when you do the research for yourself. Watch or rewatch some of my videos where I go over the ETFs and stocks that I like. Look at the things that I'm pointing out, and then use that as a template to look up other stocks and ETFs that maybe you like as well. Rule number 2. Only invest with money that you don't need in the next 5 to 10 years. The market goes up and goes down all the time, and you only lose money if you have to sell when the market's down. In 3 years from now, if the market drops and you don't have to sell any of your shares, then it doesn't really matter that the market's down. It's not like you actually lost any money at that point. But if you actually did need that money at that time, then you'd have to sell at that time, and you'd have to sell at a loss, which means that you would lose money. The best way to set yourself up for success on rule number 2 is actually to complete rule number 3. But first, since we're talking about safety and setting yourself up for success, I'm super excited to tell you guys about the sponsor of this video, NordPass, because they provide safety in your daily life, which is actually even more important. NordPass is a secure password manager that uses end-to-end encryption to protect your passwords, and since most of our lives these days involve entering at least one password per day, we're vulnerable all the time. This is a great product for you personally, and even better for your team at your business. NordPass lets you securely store your critical information, get real-time breach alerts, automate and make your life easier, and gives you secure sharing to share access between teams to make collaboration easy. See NordPass Business in action now with a 3-month trial with the link down in my description with code ProfessorGPass. Now, rule number 3 that's going to set you up for success with rule number 2 and really help bring down your total overall frustration with this whole investing thing is going to be to make sure to have a solid emergency fund. Just like number 1, I'm sure you hear this one often and probably overlook it, because I know for a fact that this is one that many people don't do. Your first goal, if you have $0 saved up right now, is to get $1,000 saved up in this account. I'd put it in a high yield savings account, especially right now because many are giving out 3.5 to 4.5% guaranteed. And as far as priority for this one, I'd say that you should not invest another dollar until you have at least $1,000 fully funded in this emergency account. After getting $1,000 in your high yield savings account, your next goal should be to get 1 month's worth of living expenses saved up. Once you have a full month's living expenses saved up and put aside, so much of that pressure is going to dissipate, knowing that if something were to happen, or if you were to lose a job or something, you'd be okay for at least a full month. That takes the stress off of your investing because it doesn't have to always perform. If you were to lose a job and have nothing saved up and you had to pull the money out when the market's down, that would be stressful. But if you have money saved up, the market's down, and you can use the money from the money that's saved up instead, you don't have to worry about the stock market at this point. The ultimate goal here should be to get 3 to 6 months worth of living expenses in a high yield savings account and never touch it. Just keep it there forever for an emergency. I'd highly suggest that you get this goal and rule number 4 done before you do any more investing. And rule number 4 is the one that keeps people poor literally forever. If I gave you a bucket and a Dixie cup and told you that you need to fill that bucket up with water using the Dixie cup, it probably wouldn't take too long. But if I were to poke a hole in that bucket, it would take you a lot longer to get that water filled up all the way because some water would be leaking out. You could get it up for a little bit, but after a little while, if you stopped putting water in, then that water level is going to keep dropping because there's a hole in the bucket. And if I poked that bucket with like 5 different holes, you probably would never get that thing filled up all the way and it would always be leaking water. The holes in this scenario is debt, and that bucket symbolizes financial freedom. You could never get that bucket full with those debt holes taking all of your water or money out of it. Most often it's credit card debt, but it could be things like personal loans or other types of loans with high interest debt. When I say high interest debt, I'm talking about debt that has interest level of over 6%. If you have student loans or something with very low interest, something like 2% or 3%, where it's even lower than inflation, then there's really no reason to be paying that off super aggressively. If you have a credit card debt of something like $5,000 and the interest rate on that is like 20%, then I would absolutely be paying that off as aggressively as possible. Think of the interest rate as the size of the hole in the actual bucket. If it's an interest rate of like 1 to 3%, think of that as like a needle, like something very, very thin. But then if the interest rate is 10% or over, think of that as like a hole the size of your fist. That's just going to keep pulling the water out of there. Getting your high interest debt paid off and an emergency fund funded is going to change your entire life. Rule number 5 is one that changed my entire financial life as soon as I heard it, and I started to see that every time I would research the best investors, it's exactly how they invest and what they do, the strategy that they use to get themselves to that ultra wealthy. If I told you to analyze all the football players in the NFL and rank them in order from the best person all the way down to the worst person, not only would that take forever, but it would also provide some type of confusion because it's very tough to compare like an offensive lineman to a kicker and what makes each of them really good, or what makes one better than the other. If I told you though, just to focus on all the quarterbacks in the NFL and to order them from best down to worst, you could do that much more effectively. The reason you can do that is number 1, the number of quarterbacks compared to the number of just total football players in the NFL is much more manageable. So you could actually go deeper researching each individual one. And number 2, you have a focus, which is quarterback. So you'd only be looking at the stats that would make a quarterback good. You don't have to worry about how far they can kick the ball or how well they can block somebody. You don't have to worry about these statistics, just the statistics that have to do with making a quarterback a good quarterback. Stocks and bonds and ETFs and other investments get very complicated, especially the more of them that you're looking at or adding in. What you need to do for rule number 5 is to focus by doing a deep dive within yourself and figure out, why are you making this specific investment? What is it exactly that you want from this investment? For me, I invest primarily in ETFs because I understand the stats of how tough it is to actually pick an individual company stock and have it perform or even beat most of these ETFs long term. It rarely happens. My why is not to beat the market or win at investing. My why is to set myself and my family up for success and be a good steward of the blessing of money that God has given me. I don't need to know about or invest in every category out there. I dwindle it down to 3 to 5 ETFs and 3 to 5 individual stocks that I really understand and know and research really deeply. Right now, in the middle of 2023, the market is quite volatile and may get worse by the end of 2023. So in this video, I highlight 4 safe investments that will make you money while everyone else is losing money in a likely recession. Watch this video now.